Hello and welcome to The Trade. Before we get into the technicals, a quick look at what traders are watching and the Trump administration maintaining that a fragile ceasefire with Iran remains in place. President Trump announcing that the operation to reopen the Strait of Hormuz, dubbed Project Freedom, though, will be paused for a short period to see whether an agreement can be finalised and signed, although the blockade will remain in force. This, as the United Arab Emirates said it suffered a new wave of Iranian missile and drone strikes, with the US ally saying it reserved its full and legitimate right to respond. US Treasury yields fell along with a decline in crude prices, the US 2-year at 3.92%, the 10-year at 4.4%. Australian 3-year government bond yields fell to 4.64%, the 10-year down to 4.98%. And in the wake of the RBA decision to lift rates by 25 basis points yesterday, markets are pricing in a 20% chance that the cash rate will be hiked by another 25 basis points at the next meeting on the 16th of June, with a 70% chance by August. NAB economists are expecting rates will be lifted to 4.6% at the June meeting, given the SOMP forecast showing higher near-term inflation and slower growth. ANZ, though, expecting that the RBA is done with its hiking and 4.35% is the peak in this cash rate cycle, while Westpac Chief Executive Anthony Miller says more of the burden of the conflict in the Middle East will be borne by households rather than businesses as they seek to pass on rising costs. Having a look at where currencies are, the Aussie dollar at 72.2 US cents. Let's get into the charts now. Chris Weston from Pepperstone joining us to delve into the technicals, particularly of the Nasdaq's recent record highs. Chris, US markets still looking attractive to investors.
Yeah, I mean, I think the tech trade, the acronym TINA is getting bandied around left, right and centre. There is no alternative. And I think, you have seen some gains in some of the material stocks. Energy's done pretty well, obviously, but there's, we're looking at the volatility and potentially a bit more of a subdued move in the crude price here. But it's tech. I mean, the Philadelphia Semiconductor stocks, the stocks index is up 57% since the beginning of April. That's 25 days. So they're saying this is the biggest move we've seen in those 25-day periods since 2000. So it just tells you what's happened. I mean, the market went into April very much underpositioned in tech and Mag 7 and semis, and there's been a major portfolio shift that's taken place. We can obviously go into the reasons behind that situation. You saw buy side all becoming very much overweight, and then that created a concertina of flow-based effects. We've seen CTAs, commodity trading advisors, systematic trend following funds, coming out and buying single stocks and Nasdaq futures. That's pushed markets higher. You've seen a lot of people buying calls for individual stock names in the index, and as prices have gone up, market makers who've sold the calls effectively have had to bring their deltas back into line and hedge out that situation by buying the underlying. Again, it's perpetuated it. You've seen slightly lower volatility, and you've seen volatility targeting funds coming in with various ETF rebalances at the end of the day, which is disproportionately buying some of these memory stocks and other factors. So it's a big flow-based effect. A lot of this is fairly opaque, but the question for a lot of people now is if you look at the chart that we've got of the Nasdaq, and we probably could have used the SOX index as well, is that it has been making this absolutely ridiculous move, and pullbacks have been very shallow. So can you buy at these levels now, or do you have to wait for a pullback, or do you short the market here? I mean, I certainly wouldn't be shorting it. There's so much, there's a reason why it's doing what it's doing at the moment, and it's doing everything right. So if you're long, stay long, in my opinion. I think that's the only way to look at this, and I think any kind of pullbacks are going to be shallow. Obviously, it depends on the rationale for that pullback, but I think it'll be shallow, and I think that'll give you an opportunity to get back in some of these names. So it's onwards and upwards. I mean, we love memory. We've loved memory for a long time. We know that Samsung now is talking that 30 to 40,000 workers are going to go on strike, in the next couple of weeks, and that's just going to impact DRAM prices even more. I mean, there's obviously a massive deficit that's already being impacted, and the data center rollout, so they use a huge amount of memory within that situation. So, you're looking at SY Hynix in Korea, it's up 144%. In the US, where we're seeing the flows, you're seeing that. I can't feel, I've had a memory block now. But you've got SanDisk, you've got Western Digital. These names are doing they're absolutely blowing up at the moment, and rightly so. And I mean, you've got the hyperscalers, which have committed $725 billion in data center investment. They're getting a return on that. We're seeing clear evidence of that the return on investment is there. The demand for compute is insatiable and it's off the charts to 2028. I mean, it's all, everyone's just had a rethink and a re-rating of this space. And I think you can't fight this movement at the moment. The technicals, there's nothing more emotive than price doing what you can see on the chart there. But as I say, the key question there is can you buy at these levels or do you just wait for a pullback? So that's the question. But I mean, I think shorting into this is you're going to get run over by a steam train if you do that.
Oh, the irony of losing your memory while talking about memory. We do love memory, though.
Very good.
We're hitting middle age. We're hitting memory loss, aren't we, a little bit? All right, well, let's talk about Bitcoin because, this bullish run, but is it behaving as a risk asset? Is it a risk asset? What are you seeing?
Yeah, I mean, you can just tell that from the correlation effect. You look at the correlation coefficient between Bitcoin and Nasdaq. It's, whether you're looking at 20, 60, 100-day 20 correlation, it's very, very high at the moment, sort of, above 80%. And, therefore, you're really looking at that situation where it is behaving as an out-and-out risk asset in that situation. Now, I think what's interesting, as you can see from the breakout, it's working in this beautiful bullish channel. You've seen a couple of failed breaks, but the one we've seen the last couple of days has kicked. And now, if you trade momentum, if you trade breakouts, you've got to be working on you're hunting for an outlier effectively. People talk about what's your win-loss ratio. It's irrelevant in this situation because you just need to take if it rolls back out for a failed breakout, you've got to take it off the table quickly, and just when it's moving up, you just got to try and hold it as long as you can and get that multi-R effect coming through. So, is this for real? Well, it feels like it is, and I think 85,000 is probably the next stop. That's what I'll be looking at. Not that I would be trading this sort of techniques with a price target, but I think that's kind of where you're looking at. But the correlation is that this is moving in line with what we're seeing in tech, high growth tech, and that puts it as a risk asset. Now, what's also driving this is you have seen consistent inflows into the various ETFs, the spot ETFs. I think on Friday we saw one of the biggest, about for the fourth biggest inflows into the 10 or 11 spot ETFs. I think the institutional guys are getting back into it. You've seen strategy in some of these Bitcoin treasury entities accumulating pretty heavily. I mean, sort of strategy throughout April, I think they picked up a lazy 57,000 coins, so that's added weight. And I think some of the leverage scene as well. You've seen quite a lot of open interest in the upside call structure. So as markets move up, the market makers have had to hedge by buying the underlying Bitcoins and the futures, and again that's moved up. Where I think, where we haven't seen the belief is in the retail component. Even the people who are just bought into the cult Bitcoin that it can only go up. They're still very skeptical on this move, and most people I talk to is like they don't believe this move. So I still think there's a lot of retail who can chase this move higher. They've just been burnt so many times that they just don't trust this trend. But the institutional guys have been getting in a little bit through the ETFs. They've got that compliant vehicle to do so. And I think if you're looking at the tape that we saw there, well, of course we don't know the future. We can only think in probabilistic terms. I would say from that right now that the higher probability is this continues to go higher.
All right. What about dollary-do, as the Simpsons say, Chris?
Well, the Aussie dollar is obviously the one that everyone gets to focus on. I actually like the Aussie against the euro. I think the euro Aussie goes lower, sterling Aussie goes lower, and I think that's where we're going. But against the US dollar, of course, I mean, this isn't so much necessarily a relative rate story, and to an extent relative growth. I think this is just this comes sort of in the Bitcoin camp where you've got it as the Aussie comes as very much a risk proxy, and the US dollar. If oil prices are falling and volatility subdued and we see Nasdaq breaking up, you're going to see the US dollar under a bit of pressure. So that's what probably takes us above 72 cents. I mean, I think if you do look at the rate structure, we're still seen as the relatively hawkish outlier still to come. I mean, the market's now pricing, a 20% chance they raise in June. I think they'll leave rates on hold there, and they're saying that the next hike, which is probably the last hike in the cycle, is in the August to September window. But I think we have seen peak growth in Australia. The Q1 GDP numbers, when they come out the 3rd of June, will be around 2.6%, reasonable consumption at a private level, and government consumption around 3.6. But that will be the peak, and it will dissipate, reasonably markedly into the end of the year. Not recessionary, I'm not in that, we're still good, and other economies will slow as well. But I think I actually sit in the camp that But we've just seen the last hike in the cycle, and I think the RBA will be cognizant to that. So whether that has any effect on Aussie dollar against the US, I think probably unlikely. I think it's probably more risk factors. If the Nasdaq keeps rallying, if the oil prices were to come back a little bit, and we do see a bit more risk on sentiment from the geopolitical case that we've been seeing, then I think Aussie dollar can push through 72 cents, and it's a question of whether the market can kick that higher from that breakout point.
All right, we'll wait and see. Chris, always a pleasure. Thank you so much. Have a good trading day. Chris Weston from Pepperstone. That does it for this edition of The Trade. Be sure to join us next time.